Well, hello, everybody. This is Michael Moskal, Director of Investments at MGO Investment Advisors. And I'm here today with John Conry and Parker Kasgan. And we are going to talk about a very hot topic in the news right now, which is tariffs and how it is going to affect your investments and the economy. Just as a note, because I have had this question before, a tariff is just a tax. And it's a tax that imposed by one country on goods that it's importing from other countries. And there's all kind of reasons why they do it. And we're going to talk about that a little bit today. The other cartoon I have up on here on the left side with Uncle Sam throwing the tariff is that these do tend to boomerang back. And I just saw on CNBC that China says they will be imposing a retaliatory tariff on the US of 15%. So what did the US do today? So we imposed tariffs on Mexico, Canada, and China. Mexico and Canada were 25% tariffs. That means goods coming in are now 25% more expensive, 10% for energy products coming in out of Canada, because we do import quite a bit of energy from Canada. China was 10%, but that is on top of what we already had a 10% tariff on China. So China is now 20%. And like I just said, I just saw that China says, fine, then we're going to have a 15% tariff on some US goods that are being imported into China. Not all negative. Generally speaking, I think we probably, as an organization, John and Parker, give a thumbs down on tariffs, generally speaking. But, there are some positives. Obviously, it raises revenue, immediate revenue. And assuming that you don't have retaliation happening, which we do, but, it immediately raises revenue because you have a tax going on that you're raising money from. And there is actually another motive here, which is protection of U.S. industries. And I know John and Parker, you guys had a couple of examples of this.
Yeah, so Honda's going to move a factory into the United States, into Indiana, actually, to produce the Honda Civic, the hybrid version of it. So instead of Mexico, they're going to put it in Indiana, and it's going to produce about 200,000 cars a year, but that's not going to be able to get up and running until about 2027, 2028, they're thinking.
And then Taiwan Semi announced yesterday a $100 billion commitment to build another chip plant. And then last week, Apple said they plan to spend $500 billion over the next 5 years, with intention to hire 20,000 new workers. So they're going to build a server factory in Houston, expect to open that next year, and a manufacturing facility in Detroit.
Yeah, so these are sort of just a continuation of what's been happening. Tariffs are something that's in the news, but really over the last few years, we've seen this more protectionism going on. I think the current president called it America First. It's been called nationalism. There's different words for deglobalization, which I have in the negative here. Another way of just saying countries are sort of trying to rein in and bring in manufacturing, bring in business into their own countries instead of trying to farm it out to different places. Negatives for the tariffs, obviously what's going to happen is for consumers, for us, it's going to mean prices are going to be higher for certain goods and services coming into this country that are being tariffed. Retaliation, like I said, is already happening now. So our companies, corporations in this country that are farming things out and exporting to different countries now are going to have higher prices with their goods. The conflict part of it is obvious. If you watch the news, Canada, Justin Trudeau was up there and he's angry about about the tariffs. He doesn't understand why it's happening. Mexico's the same way. It just creates some more conflict. And then supply chain disruption. And I think, John, you had commented about this, about just the uncertainty going on with some of the corporations.
Yeah, and any corporation using the first quarter, you're trying to plan out your year, maybe making some capital expenditures or, do some more budgeting. It's when you have uncertainty like this, it really kind of throws a wrench into things. And as an example of that, ISM is a report that comes out once a month, and it measures industrial activity. And there's a number of different factors to look at. One of those is new orders, and that's obviously one of the more important considerations. And it dropped a lot in February. It was 48.6 versus 55.1 in January. And anything above 50 is considered expansionary. Anything below is considered contraction. So that was a big drop in plans for new orders. Now these stats can be volatile, but I just think it's just indicative that business owners are kind of putting the brakes on, which is not good.
Yeah, because again, it's the uncertainty, which leads us into our next topic here, which in the investment markets, and especially the stock market, do not like uncertainty. They don't like not knowing what's going to be happening or what's happening currently, which is sort of the situation now. So that's the reason why you see stock prices falling the last week or so as people are sort of getting a little more conservative. What we're doing in response to this, by the way, with the uncertainty and the tariffs, is one, diversifying portfolios into more stable, price elastic industries like consumer staples and energy. And examples of consumer staples would be, you see the pictures on here with Tide and Charmin, toilet paper, Pampers, diapers, dog food. These are products that people will buy, not quite regardless of price, but even if the price goes up a bit, they're still going to buy it because they still got to clean their clothes. They still got to have diapers for their babies, and they still have to need toilet paper and toothpaste and all kind of products. So those are price industries that we are getting into. Same with on the energy side of things. People still need to gas up their cars, and yes, there's a point at which gas prices go high enough where people will rein in some of their travel. But I don't think that's the case, Parker. What's oil prices right now?
I know it just went under $70 a barrel for crude oil, and it's the lowest since December, so pretty cheap right now. And I even filling up my own tank, I saw it was like 249 yesterday. So
yeah, so we haven't seen that effect yet.
yeah,
But these are the kind of industries we want to be invested in that are more called stable price kind of industries. The other thing is that tariffs are negative for U.S. corporate earnings, and it's logical if you think about that, because the higher the prices of things for corporations to import to make products, they have to pass that along somewhere. So they're passing it along, or if they can't pass it along, it's going to hit their bottom line. And so corporate earnings, I saw a study done where they estimate tariffs have about a 1 to 2 percentage point negative effect on corporate earnings. The good thing is we'll see in a minute, corporate earnings have been very high in this country, which is good, but still we don't want to see it going the other way, because as corporate earnings go is how stock prices go. So again, what we're doing in response to this is diversifying portfolios into U.S. and non-U.S. companies that have very strong domestic revenue sources. So, food companies, grocery stores, I got Kroger on here. Kroger would be an example. People go shopping for food. They're not shopping for food outside the country. It's a very, very heavy domestic industry, as is, I have an example of Wells Fargo on here. Banking's the same thing. My bank's down the street here. I go banking here. I don't go banking outside the country. And then Lockheed Martin would be an example of a defense company, defense stock. And, again, providing strong domestic defense would be another area that's, with domestic revenue. So what should you do as an investor? Number one, always keeping a long-term investment plan and goals at the forefront. There's all kind of noise that happens. Sometimes it's very loud noise, on a day-to-day basis in the investment markets, things are happening. And, it's very easy to get sucked into short-term what's happening and panic a little bit. But, if you have a good long-term plan put in place, which if we put a plan in place for you, it's a good long-term plan. And, don't overreact to this, what's going on. The other thing that's happening right now is with the stock market going down a bit is that, we've been sort of overdue for what we would call a normal corrective cycle. We've not had a correction in the U.S. markets since October of 2023, not 24, 23. So it's been about a year and a half. And on average, we have a correction of 10% or so about every 12 months. So we're sort of overdue. Nobody likes to see the market go down. We don't, investors don't, but it's going to happen as part of the cycles. And, part of that benefit with that happening is it weeds out some of the speculation and gives us a good base for the market to go up further from there. Looking at the economy is still growing. We're at about 2% GDP. Although, John, you had a comment on the Atlanta Now GDP number.
Yeah, even before kind of this tariff sell-off, the market had been a little wobbly since kind of mid-February, and some other economic data came out. Jobs numbers weren't as good as expected, and the Atlanta Fed is one of the, I don't know how many Fed offices are, maybe there are 10 across the country, and a lot of them will have some predictions on what the GDP will be for that particular month. And Atlanta has a history, at least for the last few years, of being on the high side, and they've been right a lot because because a lot of Feds were more cautious. But in this most recent adjustment for this quarter, they had been in a 2.25 range, I think, and they knocked it down to -1 just last week, and that kind of spooked the market a little bit. And the reduction was primarily due to a big spike in imports, and the big spike was largely due to companies trying to front run the tariffs, and imports are a detractor to GDP. So that's the big reason why, their number came down. But I think as the quarter plays out, they'll probably still end up positive. Where it's going to be 2%, 1%, still a little too early to say, but it's probably not going to be as negative as right now.
Yeah, it would be highly, highly unusual. I'm trying to think if I've ever actually seen a time where you have a negative GDP print and corporate earnings are strong and going up. That's almost like an incongruous equation there.
Right.
So, corporate earnings number 4 on here, still very strong. We had 18% year-over-year growth for corporations in their earnings in the fourth quarter of 2024. That was reported in this first quarter, which was higher than expected. It was expected 12%. So corporate earnings are not weak. Now, it doesn't mean they won't get weak as the year goes by, perhaps. And tariffs, of course, like I said, can have a negative effect on that too. But, as of right now, corporate earnings still look very, very strong. So that bodes well for stock market for this year. And then we're very much a believer, tariffs are not a new thing. The first tariffs that we had in this country actually were in the 1789, the Tariff Act. Okay, so in the 1790s, we had tariffs playing themselves out. And throughout our history of this country, we've had tariffs, some high, some low. And, they always sort themselves out at the end of the day. And we believe this situation will also sort itself out. And the market will back to be focusing on the economy and corporate earnings for, to look for guidance to where the market's going to go. But we'll keep a very close eye on the situation, and we'll keep making changes to portfolios as we see necessary, for all the situations that happen. Any other comments, John, Parker?
Yeah, again, what you mentioned before, we were kind of due for a correction. We had, 2 years of 20% plus growth, minimal downside. Historically, I think if you look over the last 45 years, the average downturn in the market's like 15%. And despite that, the market's been up like 75% of the time over that period. So, we're getting a little taste of that medicine right now.
Yeah, again, they're part of the normal cycles. When you have these downturns, they don't feel good because no one likes to see account values going down. But it is, if you've been around long enough, you see the cycles play out. And as long as companies in this country are still growing and still making money, Apples and Metas and Googles and Chevrons and all the, all the different Procter and Gamble's, all, these companies, corporations are making money over time, then you'll see the stock prices go up over time. That's kind of the equation. So we expect it to happen. We just got to get through these, weak time periods.
And another thing that's helped our portfolios is our international exposure. So,
yes, what is our international exposure?
About 29% right now, but I know we're working on a rebalance to push that over 30%. And foreign markets have way outpaced the U.S. markets this year.
Yeah, what's the foreign markets up this year?
I think it's up about 9%.
Yeah, that's about right. So yeah, Parker brings up a great point, by the way, because we are looking outside the U.S. In one of the slides we had back here, we talked about non-U.S. companies also that we're looking at that have strong domestic revenue in their countries. So that's part of what we're looking at too, and we'll continue to go that direction. All right, well, thank you for watching and listening, and we'll keep a close eye on the markets and your investments, and we will see you soon.